Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Friday, April 13th, Friday the 13th, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. So today the market did finish down a little bit. It was back and forth for the majority of the day. In the afternoon, we had a nice little sell-off and then a recovery that lasted about a half an hour, maybe 40 minutes into the end of the trading day. But there's definitely some interesting information out here in the markets, and I'm going to get through as much as I can. I have a lot of notes, and I want to go through a lot of things with you because as I look through the markets, I tend to look at a lot more of the markets, meaning I look at a lot more charts, I look at a lot more time frames at the end of the week because for me, the weekly close is important, number one, and also I like to see from a bird's eye view perspective what exactly happened all week long with a lot of different markets. So we're going to look at a couple of different charts than we normally look at each and every day. And the purpose of that is to try and get the largest, best, and biggest picture we can for what's happening under the hood of the markets. Before we dig in, let me make mention of the fact that I really do appreciate all the comments that come from these videos. Keep them coming. I love the interaction. It's a lot of fun for me. I love answering the comments. I'm pretty sure I answer each and every one of them. And I really do enjoy getting the different and varying perspectives that you all have on the markets. That's what makes a market, is the fact that two different traders, two different investors, two different analysts, whatever you want to call yourself, two different people can look at the same market, the same chart, and see completely different things. And that's the fascinating part about the markets. So keep the comments coming, like the videos, share the videos with someone you care about, someone you think would be interested in this information. It's helpful to me. It's like repaying the favor for me doing the content of these videos. I certainly do put a lot of work into this. It's for your benefit. I love doing it. As a repayment, I appreciate the fact that you like and share the videos. So today, when you look at the daily chart of the Spider, you can see here that earlier today, we did try and get above the 266.75, and we failed. And the market put in somewhat of a reversal day. I'm not going to really call this much of a reversal day. It looks like a reversal day from a candle-to-candle perspective, but we're not going to really call it a reversal day. We're just going to call it another failure to break out above the 266.75. You can see the importance of that level. And here's another thing that's important. We always have to look at both sides of the market. We have to take into consideration the bullish case, and we have to take into consideration the bearish case at all times. As you know, I still look at this from a longer-term perspective as essentially a bearish wedge pattern. And these patterns do have a tendency to follow through or a continuation to the downside. So I've still got my eye on the 250 or slightly above or slightly below that level to finish up this move. Doesn't mean it's going to happen on Monday, doesn't mean it's going to happen on Tuesday, but ultimately I think it does happen. It's just a matter of when, not necessarily if. That's taking the long view. Now let's take the short view. Obviously, two things can always happen. The market can go up or the market can go down. But when you look at the shorter time frame, or not shorter time frame as much as the last few days of activity, you can see here that we've basically been consolidating essentially underneath, not being able yet to break out above, but we've been consolidating underneath this 266.75 level that's really been giving the market a hard time, not being able to get above on a sustainable basis above that level. However, when you look at this, you say, well, we've really, over the last 3 to 4 trading days, including today, we've been consolidating pretty much right underneath that level. Is that the market's way of telling us that it's building energy for another push higher? Another push higher could be into the moving averages. You have the 100 and the 50 period moving average right up here. You also have a gap that was left open by the gap down that occurred on, I believe it was the 22nd or 22nd of March. So we have an open gap that needs to be filled at some point in time. That's above the moving averages. So those are areas that certainly, if the market is consolidating from a short-term basis perspective underneath this important level, then are we consolidating to push higher into or through these moving averages, fill that gap, maybe even slightly higher? Could we get up a little bit higher than the gap? Of course we can. Would that turn the market bullish or would it remain bearish is the question. From a short-term perspective, getting above the moving averages is certainly at least leaning towards the bullish case. If we stayed up there for a sustained period of time and went sideways again, that would be bullish. That would be the market's way of building energy for another push higher. But we really just have to take it one day at a time, and we'll see what happens. Keep in mind, and this is extremely important, next week is options expiration week. Why is that important? It's important because the institutions, the one that's controlling most of the volume in the markets, the institutions have a tendency, not each and every month during options expiration week, however, a lot of the time, they have a tendency to whip the market around. You'll see up days and you'll see down days, and because of where we are on the chart, and we're into some pretty critical levels here, I wouldn't be surprised to see some volatility come back to the markets next week. We could see some upside, and we can also see some downside as well, all during next week's activity. So you have to be on guard, expect the unexpected. You never know. The upside is certainly not off the table. And with the longer term pattern that's developing on the chart or has developed on the chart, the downside is certainly not off the table. I would say the first indication of bullish or bearish behavior is above or below the 266.75. So as long as we stay below, I think the market has to have a bearish bias. If we get above and we close above on a daily chart closing basis, certainly first hourly. So if we close hourly above 266.75, and remember the hour happens to be on the half an hour. The market opens at 9:30 in the morning, so each and every hour after that, so it's on the half an hour mark, is considered an hourly close. So if we begin closing hourly above that level and then close daily above 266.75, you're going to have to look at the market with somewhat of a at least short-term bullish bias. Now let's have some fun looking at the shorter time frame and take a look at what happened Friday afternoon when the market declined, and I'm going to show you how a trader was able to determine where a logical area of support was. And I'm not suggesting it was easy, I'm just suggesting how it's done. Here's a 10-minute chart. And by the way, when I say how it's done, what I mean by that is it does take some work to figure out where the support will be. And in this case, I'm going to use a couple of different charts. In fact, I'm going to use several different charts to show you why the market found support where it did. So if I just look at the 10-minute spider chart and the market's declining, my first inclination is that we're going to fill the gap right here down where I just put this horizontal line. But you'll also notice the market never got there. So if I'm looking at the spiders and they're declining like this, and by the way, I wasn't even around when this happened. I had some errands to do. I don't do a lot of trading Friday afternoon, primarily because, generally speaking, the market goes to sleep the second half of Friday, and the opportunities are generally few and far between Friday afternoon. So I wasn't really watching the screens when this happened. However, interestingly enough, I did see it from my phone. I use TradeStation, and the trading app that they have for the mobile app for the phones is really wonderful. You see clear and concise charts, and the trading app is actually pretty good. So I'm always checking the numbers, and I looked at the charts, and I saw this as clear as day while it was happening, but I'm not making trades from my phone. It's just not something I'm interested to do. So just looking at the spider chart, I'm waiting, looking at this 10-minute chart, I'm waiting for this 263.75, 76, 77 area to come into play. That's where this gap was, and that's where the logical area would be, at least from my perspective, where the market would want to come to and likely bounce off of. So that would have been a good long trade. Now there's another gap in the candle right to the left of this that comes in right here, but you know what? The market even came up short of that gap. So you have to scratch your head and say, well, what caused the market to find support at that area? So you have to look elsewhere. So the 10-minute chart is a head scratcher, so I'm going to go and look at a 60-minute chart, see what I find. Here's the 60-minute, and I really don't find anything different. Same gap, obviously, and there's no clear and concise reason why the market failed to fill that gap and bounced higher. So again, it remains a head scratcher. So if I can't find the information I'm looking for on the spider chart, let me go over to a different chart. I'm going to go to the S&P E-mini futures chart. Here's a 10-minute chart, S&P E-mini futures, and this is the pit session only. So the gaps you see is because that this chart begins when the market opens. So again, here's the 930 to 940 candle, and there's, here's another one. Here's today's activity, 930 to 940 candle, and then here's the open gap. So this shows open gaps because it's the pit session only. But there's two ways to look at a futures chart. There's pit session, and then there's a continuous contract chart. Now here's another horizontal line. You'll notice where the bottom was today on the futures contract. It did fill this gap here. Didn't fill the lower gap, but it did fill that gap. Would I have been willing to take a trade at that gap just looking at this chart? Probably not. Just looking at this chart, I would still have been waiting for this lower gap to get filled. And here's where it gets interesting, because this is something I discuss in detail in the course at Lazy E-mini Trader, which is looking at various charts on various different time frames because they're all telling you something different. Here's what I mean. Here I'm looking at a 240-minute chart. Basically, each one of these candles represents a half of day of activity in the markets. Now you'll notice the chart looks different than the chart. Look, if I even go to the pit session, you'll see that it does look quite different. So here's the pit session only. This shows the opening and the closes of the day. And then when you go back to the continuous, in my chart it's called regular session, this is the continuous contract, it looks completely different. I look at both. I look at both all the time. Generally, when I show you commodities like gold or crude oil, I'm showing you a continuous contract, but I also look at the pit session during the day as well. Now, most of you can already see what I'm looking at. However, first I want to mention that how many times have you heard me say markets love to come back, check in at former breakout and former breakdown areas? I say it all the time. Why do I say it all the time? Because it's a truism. It happens all the time. Now look what I'm going to show you. Here's a big up candle, okay? This happened at 10 o'clock in the morning yesterday on Thursday. The low of this candle is 26.45 and a quarter. This was a breakout candle. So what happened? The market came back to check in at a former breakout and a former breakdown area. See that black line I just drew? If I take that off, you'll see, let me move the chart over, you'll see that the low of the day today was 26.4475 against the low of that breakout candle of 26.4525. So you can see that as the market came down to test the bottom end of that breakout candle, that's where we found support. That's where the market bottomed. That's where my explanation comes in of why did the market find support where it did. Now, I'm not suggesting that in real time it would have been easy to spot this, easy to trade this. That's not what I'm saying. But sometimes when you look at various charts, you find something very quickly that's easy and obvious. It hits you like a ton of bricks, and it turns out to be a wonderful trade. And this basically takes practice. It's something that I've been doing for a very long time. But certainly, the more you do it, the better you get at it, and the more confident you become in the fact that the market should find support or find resistance at certain areas over and over again like clockwork. I'll give you two other case in points on the other side of the trade, right? The short side, you can see right here. Here's a breakdown candle. The market came back to test the top of the breakdown candle, and what happened? It failed, and the market sold off pretty good. Here was another one. Okay, breakdown candle. The market came back to test the top of the breakdown candle and sold off pretty good. Which leads me to, where do we go on Monday for the first half of Monday? If this is each one of these candles is basically a half a day of activity, what does this actually look like? This is a bullish consolidation pattern until and unless we close below the low of this big break up candle or breakout candle, until we close down here below these moving averages, this is still in a bullish pattern, a bullish formation. What does that tell you? That tells you that the market, from a 240-minute chart perspective, is building energy to push higher. That's what this chart is telling me right here, right now. Will it happen? Well, we're never 100% sure of anything that's going to happen in the market, but this pattern, until this low is broken on a closing basis, meaning a half a day's close below 26.45 and a quarter, until that happens, this is building energy to push higher. Where could this pattern go? This pattern could go right up to the 200 period moving average. That would be the natural place based on this chart, what we're looking at right here, right now. That would be the natural place that this market would go to and stall out right around 26.90. Write that down. Remember, we discussed it. We'll see what happens over the first maybe day or half a day or so next week. And realize one of the things that I emphasize over and over again in my course is that all charts act and react the same way. That's why I teach traders to look at various different time frames to get the best indication of what the next likely move in the market's going to be. All right, back to other stuff. Now we're looking at the IWM, the Russell 2000 Index, my favorite market-leading indicator on the up and the downside. And you'll see here, today we tested once again the upsloping long-term trend line. We peaked above it, and we failed again. The low of the day happened to come right in around the 100 period moving average on the daily chart, so it's a 100-day moving average. And we finished down about 0.5% in the Russell 2000 Index. Is the Russell or the IWM telling us anything substantial in either direction, on the upside or the downside, something we didn't know from yesterday? Not really. We're above all the moving averages, so it's not entirely bearish. And if the market catches a rally next week, certainly the IWM either will lead the way or go right alongside the market. Here's the VIX. I made a very strong point last night of talking about the bullish pattern and the fact that it has not failed. Today, the bullish pattern in the VIX failed. What's that telling us? Well, it has to be telling us that there's likely upside coming in the market. It has to be looked at with at least a bullish bias. That's what the chart is telling us. That's what the chart pattern is telling us. That's where the close from today, that's what it's telling us. Obviously, it's not an absolute, but in terms of the bullish pattern that was developing, that was building energy for another move up, that temporarily, at least for now, is off the table. The odds favor. Right now, the probabilities favor that the VIX actually comes down farther and most likely into the 100 period moving average, which is this purple trend line at 1561. We'll see if that happens or not, but that's what the probabilities are telling us. Markets are based on probabilities. And we know nothing works out 100% of the time, but the way in which I look at the markets and the patterns and the breakout points and the breakdown points, the way that we analyze the markets, this stuff works out around 75, maybe 80% of the time. I'll take those odds all day long. So what's this telling us? If the VIX is going to go lower, does that support the case that the stock market is likely to go higher at the same time? And the answer is yes, it does. And interestingly enough, the VIX went lower by almost 6% today while the market was down. Keep in mind, the S&P 500 was down over 7 points today. The Dow Jones Industrial Average was down 122 points. The NASDAQ Composite was down almost 0.5%, or about 33 points. So markets were down, VIX was down. One of them is right, one of them is wrong. They can't both be right. Can we get a divergence from one day to the next between the VIX and the stock market? Absolutely. We just saw it today. Something is diverging. It's just a question of, is the VIX going to turn around and go up if the market goes down, or does the market go up and the VIX has become a leading indicator of that move based on today's activity? Well, we saw a 240-minute chart that was a bullish pattern in the futures contract. That's really the same market as the spider. It's the same market as the S&P 500 cash index, or the SPX. So the S&P is telling us that the 240-minute chart at least is telling us that higher prices are likely, unless we close below the important number that I showed you. Transportation average, my second favorite market-leading indicator. Nothing's really changed. The transports were up 9 points today. That's just a rounding error. This is a bearish pattern. Could we go higher? If the market goes higher, certainly the transports will trade higher. The line in the sand for me is really here, maybe filling the gap, which is just a stone's throw above that. That's the line in the sand. You begin closing the day above these levels, up in this zone here, and that's going to turn the transports bullish in my book. Until and unless that happens, we can come up to test that area, and if we get through it, that can be bullish, but if we fail, that'll be bearish. And so we'll leave it at that. But right now, today, there's no change in the outlook for the transports. If we get a lift higher and a rally in the markets, expect the transports to follow suit. It's the rising tide will lift all boats scenario. Now here's the broker-dealer index, and the reason why I want to bring this up is because there's something very important happened. So today was the beginning of earnings season, and that's the perfect recipe for all my gap traders. So those of you that are familiar with the lazygaptrader.com, we trade the gaps, and earnings season, we trade the morning gaps. And what that is, when stocks are gapping higher or lower at the opening bell, that creates the opportunity for day traders. And what happens is during earnings season, we get just a litany of stocks gapping higher or lower in the morning. And what we're able to do is identify the highest probability support or the highest probability resistance area, because those stocks will either trade to like a magnet, a support area, and bounce higher, or vice versa. They'll trade higher on a gap higher in the morning, they'll trade to a resistance point, and they'll reverse from that resistance point, creating a short trade opportunity. So the earnings season is really the perfect recipe for the gap traders, and we had the beginning of earnings season today, and it begins with the big banks. So we had JP Morgan Chase, we had Citigroup, we had Bank of America, and there was a couple of other banks out there. But the majority of earnings will really get kicked off and started beginning next week for several weeks in a row, and they're just going to come fast and furious, and it's a lot of fun. We get a lot of opportunities from the gap trades. But that's not the point. The point is, looking at the XBD, the broker-dealer index, you see it was a pretty ugly day, down 1% for the broker-dealer index. We started to trade higher, traded right into this pivot high here, and reversed pretty ugly. So earlier in the day, and you can see it on a 10-minute chart, for example, here's the pit session. So here's the first candle of the day. We're all the way up here, spiking higher, and we basically collapsed in the broker-dealer index all day. And here's what happened. So let's now take a look at JP Morgan. And there's a method to the madness. There's a reason why I'm showing you this. So here's a 10-minute chart of JP Morgan. Same thing. It looks obviously the same as the broker-dealers, and you can see the collapse. I'll just go back to the daily chart, and we'll see. You can see this is a reversal. Okay, so this is a bona fide reversal. We filled a gap, so look where this gap is. Market went right up to fill the gap, collapsed, reversed, and put in a reversal day on the daily chart. I think that's important. Remember what I always say. The financials are going to come along with the market, or the market's going to come along with the financials. But it's very infrequent that they're going to diverge. It's very infrequent that the financials are going to be going down while the stock market's going to be going higher, and vice versa. So generally speaking, in order for the entire market to rally, you have to have participation from the financials, the big financials. And on the same token, if the financials are selling off, it seems to me, and history will prove itself, that it's unlikely you're going to get a huge rally in the market with the financials selling off at the same time. It just doesn't happen. One day, yeah. 2 days, yeah. A couple of days here and there, certainly, but not for the bigger moves. So I think this is important. It's a reversal day for JP Morgan. So this is telling us a little bit of a different story than the 240-minute chart of the S&P 500 E-mini futures contract. I am aware of that. Something is going to give sooner or later, but we have to take in all the data. These are all puzzle pieces that get put on the table, and once we're able to put the puzzle together, it's generally a high probability trade right in front of us. Here's a chart of Citigroup. Same exact deal. Filled a gap, right into the 20-period moving average on the daily chart, collapse lower, reversal. And we'll just talk about news for a second because I think it's important to just be aware of this and recognize. The banks reported earnings at around 7 o'clock in the morning or slightly after 7 o'clock a.m. this morning. So what happens is the banks were trading higher when they reported. So I'm certain, and I wasn't watching, I don't really watch that much of CNBC. I try not to because it has a tendency to skew your thinking. So what happened is, I can guarantee you that they were all giddy in the media because the bank stocks were trading higher and the market was opening higher. The futures were higher. Everything was going to be fine. We were going to have a nice big positive day. And then the banks turned around, the market turned around. And what's interesting is the reason, according to the media, and again, I wasn't watching, but I'm sure this happened, the reason the market was up was because of the bank earnings were good. The banks were rallying, the market was rallying, and then all of a sudden they turned around. Well, the earnings didn't change after the market opened, so what really happened? And therein lies what I always try and stress, which is it's not the news that drives the market, it's the market that drives the news. And it's a hard concept to wrap your head around, but think about that for a second. Think about what happened this morning, and think about the fact that nothing changed, but the market turned around. The banks reported their earnings already, and the initial reaction was positive. But why did the banks turn around, and why did the market turn around? It happened for a reason having nothing to do with the banks at all, but according to the media, the market and the banks were up because of their earnings report. Then later on, when everything turns around, I'm sure that they had to come up with an alternative reason why it happened. They always do. It's just a fascinating phenomenon. Checking in over in the gold market, you can see here we had an up day in gold today after the reversal or down day yesterday. And I neglected to notice something the other day. When gold spiked up on Wednesday, what I didn't take a look at is the GLD chart. And I want to show it to you now. So GLD, look at this. Looks totally different than the gold futures contract. Look what happened. We put in a tail candle, a huge tail candle, after we hit this double top over here. So it's the same double top we hit on the futures contract, of course. But however, you can see a very well-defined tail candle. This is interesting because this isn't what we saw in the futures contract. So shame on me for not recognizing this, but there's a lot of stuff to look at. And just like everybody else, I just missed it. We all miss things from time to time, so shame on me. Not that we had a trader. I had a trade in gold. I haven't been in a trade in gold in quite a long time because it's been, just back and forth, back and forth. There's been no clearly defined picture of what's coming in gold, at least to me. So I haven't been long, I haven't been short, but what I find interesting is that if we go higher in gold, let's say we go higher and we start to climb up this tail candle, that gives us a potential trade. And what I mean by that is we have something to trade against. I talked about this the other night. Trading against something means that we know that this trade stays active on the short side. Now, I wouldn't necessarily short it here, but I would like to short it, just talking about GLD for a minute, if we got up to around 128.5, for argument's sake, 128.60, something in that neighborhood, that would be an area I would be interested to short gold. Why? Because I have something to trade against. Look, the high from Wednesday was 129.47 in GLD. I know that if we close any day above 129.47, that short trade has to come off the table because it's wrong. But until and unless gold closes above this tail candle, then this is going to be an active short opportunity. That's what this tail candle is telling us. And by the way, I realize I'm giving you what seems to be a lot of information on all these different charts. It's a lot to take in. Now think about this for a second. It's a snippet of what's in the course at lazyeMinitrader.com. If you really want to learn how the markets work, then you have to come over and check out that course. It will absolutely change the way you look at and view the markets from the point you take that course forward. Here's crude oil, and I know this video is getting long in the tooth. We're going to wrap it soon. Crude oil is still bullish. We had slight up day, about 0.5% today in crude oil. My stance has not changed in crude oil. we're a little bit extended on the daily chart. So I wouldn't be surprised, like I said last night, to go sideways for a while. Let home base, the 20-period moving average is always home base. Let home base or price have a chance to come back together. The market never likes to get too far away from home base. So we're getting a little extended now, but there's nothing wrong with this chart. As far as I'm concerned, nothing has changed, and I've been saying this for a few months now, that we could get all the way up to $73, $74 a barrel in crude oil, at which time it may become a wonderful shorting opportunity. We'll have to see what happens, how, and if it gets there. But for now, this is bullish and higher prices are likely. You can see here that trend line that we drew in here long before price got to the trend line. That held. We reversed very strongly off that trend line. Keep in mind, crude oil was about $62 a barrel at that trend line, which was on the 6th of April last week. And here we are at $67.39. That's quite a move in the price of crude oil. And guess what, folks? With that, I'm going to give it a wrap here tonight. It's everything that I wanted to and intended to discuss. So I'm going to wish everybody a fantastic weekend ahead. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.